What if everything you've ever been taught about risk, about diversification, and about how markets move is fundamentally wrong? You've heard the rules. Markets are mostly calm, big changes are rare, and stock prices follow a predictable, gentle bell curve. This is a world of mild randomness, a kind of comforting, manageable chaos that can be tamed by simple mathematics. But if that were true, how do we explain the massive, terrifying events that shouldn't happen even once in the age of the universe, but seen to happen every decade? How do we explain the flash crash that vaporizes billions in minutes? The 2008 collapse that wiped out centuries of wealth? The wild, unhinged swings of Bitcoin? The answer, according to one of the most brilliant and iconoclastic mathematicians of the 20th century, is that the markets are governed by a different kind of chaos. Wild randomness. They don't follow a simple curve. They are fractal. Welcome to Capitura. Today, we're not just reading a book. We're breaking down a revolution. We are going step by step through the masterwork of the father of fractal geometry, Benoît Mandelbrot. The Misbehaviour of Markets, a fractal view of financial turbulence. The author and his radical idea. Benoît Mandelbrot was not a stockbroker or an economist. He was a pure, iconoclastic mathematician who specialized in patterns of irregularity. He invented the term and popularized the study of fractals, which are rough or fragmented geometric shapes that can be split into parts, each of which is, at least approximately, a reduced-sized copy of the whole. His initial work wasn't even in finance. He studied the roughness of coastline, the shape of trees, and the static and phone lines. He discovered that nature is governed not by the smooth, predictable shapes of Euclidean geometry, circles and lines, but by jagged, self-similar, and endlessly complex fractal structures. In the 1960s, while working for IBM, he started looking at an unusual dataset, the historical prices of cotton. What he discovered shattered the prevailing theories of modern finance. He found that the day-to-day changes in cotton prices, when scaled up, looked exactly the same as the month-to-month changes and the year-to-year changes. The turbulence was self-similar across all time scales. This was the birth of the fractal view of financial markets. Why the misbehavior still matters. For decades, the financial industry operated on a theory inherited from the early 20th century, the efficient market hypothesis, EMH, and its corresponding statistical model, the normal distribution or Gaussian bell curve. This model assumes prices are independent. Tomorrow's move has nothing to do with today's move. Volatility is mild. Extreme events are incredibly rare, as predicted by the thin tails of the bell curve. Mandelbrot proves, through decades of empirical data, that the financial market violates both of these assumptions. The problem of the event. The traditional model says a Six Sigma event, a price swing that should happen less than once every few billion years, happened multiple times in the 20th century alone. Mandelbrot shows the market's tails, the likelihood of extreme events, are fat, meaning wild, catastrophic, and exhilarating events are far more common than theory allows. The clustering of volatility. Mandelbrot's fractal model shows that price changes are not independent. Market turbulence clusters. Periods of extreme chaos are followed by more chaos, and periods of calm are followed by more calm. In the current financial climate, Mandelbrot's work is the only rational way to explain the extremes we see daily. Meme stocks and Bitcoin bubbles. The wild parabolic swings of GameStop or Dogecoin are not once-in-a-century anomalies. They are the natural result of wild randomness. The ability of an asset to soar 1,000% in a month is inherent in the fat-tailed, self-similar structure of financial markets, fire movement, and risk management. Investors building long-term wealth, like the fire movement, are often told to diversify based on the assumption of mild randomness. Mandelbrot forces us to confront the fact that in a fractal market, true diversification is almost impossible because when the big wild events hit, all assets tend to move together. The flash crash. Events like the 2010 flash crash, where trillions in value evaporated and reappeared in minutes, are proof of Mandelbrot's scaling law. The turbulence is the same at the minute-by-minute scale as it is at the month-by-month scale. We are going to explore how Mandelbrot's concepts of fractal time, the Noah effect, and the Joseph effect can help us understand and manage risk in a world that is far more unpredictable and far more exciting than the financial establishment wants us to believe. Let's begin to understand the misbehavior of markets. Chapter 1. the case against the bell curve. Mandelbrot begins with a direct, uncompromising challenge to the foundation of modern finance, the bell curve or normal distribution. He calls the standard model a convenient but catastrophic error. The comfort of mild randomness. The bell curve, often associated with the work of Carl Friedrich Gauss and later applied to finance, represents mild randomness. It suggests that most events cluster tightly around the average, and deviations become exponentially rare the further you move from the center. In this view, the probability of an extreme price movement, a Six Sigma event, or 6 standard deviations from mean, is so tiny that it is practically zero. This Gaussian model underpins almost all traditional financial tools. Standard deviation, the standard measure of risk, which assumes volatility is mild and easy to quantify. Modern portfolio theory, MPT, the idea that risk can be managed through diversification, relying on the assumption that assets are independent and that extreme losses will be offset by gains elsewhere. Black-Scholes model, the fundamental formula for options pricing, which assumes that price changes follow a continuous, smooth random walk dictated by the bell curve. Mandelbrot's argument is simple. Financial data doesn't fit the curve. When you plot historical price movements, the curve that describes them is not the thin-tailed Gaussian distribution. It is a curve with fat tails, the empirical evidence of fat tails. Mandelbrot points to decades of market history to prove his case. The frequency of extremes. He shows that severe price changes, 5% or more in a day, happen far more frequently than the standard model predicts. The frequency of once-in-a-century or once-in-a-millennium events, when calculated by the bell curve, occurred multiple times between the 1920s and the 1990s. The events that the Gaussian model says cannot happen are, in fact, regular occurrences. The power of the extreme. In the Gaussian world, a few extreme events barely move the average. In the market's real, fat-tailed world, the extremes are so large that they often dominate the total price change over long periods. He quotes the finding that half the total variation in cotton prices over one 60-year period could be accounted for by just 10 days. This proves that the core of market risk lies in the extremes, not the averages. This is a distinction between mild randomness, where averages matter and extremes are relevant, and wild randomness, where extremes matter and averages are deceptive. Financial markets are governed by the latter. Modern investing application. The bell curve's failure explains why so many risk models failed during the 2008 financial crisis and why volatility remains high today. The failure of value-at-risk VAR models used by large banks try to quantify the maximum potential loss over a short time frame with a high degree of certainty, e.g. 99%. VAR is based on the bell curve. During the 2008 crisis, the 1% loss event predicted by VAR models happened on dozens of days. The models failed because the actual tails of the market were far fatter than the mathematics allowed for, leading to the systemic underestimation of risk. Crypto and the wild swing. Traditional finance struggles to model the price swings of Bitcoin. A Gaussian model would require the daily movement of Bitcoin to be a trillion sigma event. Mandelbrot's model, with its fat tails, is the only way to logically fit these extreme, regular swings into a statistical framework. When you invest in crypto, you are explicitly accepting wild randomness, diversification, and black swan events. Investors are taught that diversification protects against market moves. The bell curve model assumes that a crash in one sector will be offset by gains in another. The reality of the fat tail market, especially during a crisis like the 2020 COVID crash, is that almost everything goes down together. The extreme event is so powerful that correlation goes to 1. This forces the intelligent investor to recognize that true protection lies not in diversification alone, but in cash reserves and margin of safety that can withstand the unavoidable systemic crash. The lesson of Chapter 1 is to ditch the comforting illusion of mild chaos. If your risk management strategy depends on extreme events being impossible, it is doomed to fail when the inevitable fat tail event arrives. Chapter 2. A general critique of the efficient market. In Chapter 2, Mandelbrot turns his sights on the efficient market hypothesis, EMH, the philosophical counterpart to the bell curve. EMH has 3 core assumptions, and Mandelbrot shows why the market violates them, leading to its misbehavior. The cornerstones of EMH. The EMH, in its strongest form, asserts that all available information is instantly and accurately reflected in the market price. This is often interpreted as meaning rationality. Investors are rational and unemotional. Independence. Price changes are independent of the past. If the price went up today, it is no more or less likely to go up tomorrow. This is the IID, independent and identically distributed, assumption NO free lunch. It is impossible to systematically beat the market through analysis, technical or fundamental. Mandelbrot accepts the philosophical conclusion of no free lunch, that it's nearly impossible for an amateur to consistently beat the market, but he viciously attacks the rationality and independence assumptions. The attack on price independence. The IID assumption is necessary for the bell curve to work. Mandelbrot shows this is empirically false in financial markets, where there is a clear, systematic pattern he calls the clustering of volatility. Turbulence clusters, large price movements up or down, tend to be followed by more large price movements. Periods of calm are followed by more calm. Volatility is not uniform. It arrives in bursts. Implications. This clustering means that the market has a kind of memory. The previous day's activity impacts the likelihood of the next day's activity. This memory is a hallmark of the fractal structure and violates the independence assumption of the Gaussian model. If the markets are not independent, then they are not behaving according to the model used to price and risk manage them. The attack on rationality, behavioral finance. While Mandelbrot's core work is mathematical, he aligns with the findings of behavioral finance, noting that the existence of extreme events and long-term trends is inconsistent with purely rational actors. Greed and fear, the Fat Tails Chapter 1, are a symptom of human greed and fear. The rational market should never have the massive, unhinged swings we observe. These swings are driven by collective emotional frenzy. Mandelbrot concludes that the EMH is an oversimplification, a useful starting point, but fatally flawed because it chooses a smooth, manageable form of randomness mild over the true, systemic randomness wild that dominates market behavior. Modern investing application. The clustering of volatility is central to market timing and momentum strategies today. The problem of trend following. Many active traders use momentum or trend following strategies. These strategies exist only because of Mandelbrot's finding that volatility clusters. If the market were truly independent IHD, trend following would be statistically meaningless. The clustering of volatility creates the illusion of a prolonged trend, which traders try to exploit. The volatility ETF, VIX products based on the VIX, a measure of market volatility, are directly linked to the idea of clustered turbulence. When the VIX spikes, it signals a period of high, clustered turbulence that is likely to persist. Investors use this as a signal that the fat tails are active. Tesla hype and volatility. A stock like Tesla exhibits classic cluster volatility. When the stock is moving wildly, it tends to continue moving wildly, attracting traders who thrive on that turbulence. When the stock is calm, it stays calm. Mandelbrot's work gives us the mathematical language to describe this self-feeding cycle of market mood. The key takeaway is that the market is not a coin flip. Price movements are interconnected, and risk is not a constant. It is a contagion. Your portfolio must be structured to survive the unavoidable periods when the contagion of turbulence spreads. Chapter 3. Fractals and the Art of Roughness. To replace the smooth, flawed mathematics of the bell curve, Mandelbrot introduces his revolutionary tool, fractal geometry. This chapter is the introduction to the art of roughness, geometry of the smooth versus the rough. Traditional Euclidean geometry deals with smooth shapes, lines, circles, cones, and spheres. The problem, Mandelbrot argues, is that nature is not Euclidean. Clouds are not spheres. Coastlines are not circles. The fractal signature. A fractal is a shape where the roughness or irregularity of the object is preserved at any scale. This property is called self-similarity. The coastline example. If you measure the length of a coastline on a map, the length you measure depends entirely on the length of your measuring stick. The shorter the stick, the longer the coastline appears, because you pick up more and more nooks and crannies. The roughness is infinite, and the pattern repeats. This self-similarity, the pattern looking the same regardless of whether you zoom in or out, is the key to understanding market prices. Fractal time and scaling. Mandelbrot shows that price charts are essentially fractal coastlines. Self-similarity of price. A chart of price movements over 1 year. If you remove the labels, looks visually indistinguishable from a chart of price movements over 1 week or 1 day. The jaggedness, the sudden spikes, and the period of calm all repeat across the time scale. The fractal dimension. Instead of the smooth dimension of 1, a line, or 2, a plane, Mandelbrot introduces a concept of fractal dimension, a number between 1 and 2 that measures a degree of roughness or complexity. The more jagged the market price, the higher its fractal dimension. This number provides a new, more robust way to measure risk than the flawed Gaussian standard deviation. The fractal model allows us to abandon the idea that volatility is a constant, like the bell curve assumes, and replace it with the idea that volatility is scale-dependent and self-similar. Modern investing application. The concept of the fractal market is essential for day traders and institutional quants. Day trading and intraday noise. The day trader who spends hours looking at 1-minute price charts believes the tiny price wiggles are meaningful signals. Mandelbrot's work suggests that those wiggles are just the self-similar fractal noise. The turbulence on the 1-minute chart is qualitatively the same as the turbulence on the 1-month chart. This warns a day trader that they are wrestling with an infinite, scale-independent opponent. The algorithmic response. Modern quantitative trading firms, quants, have moved away from Gaussian models and explicitly use Mandelbrot's concepts. They model markets using techniques like Hurst exponents, a measure of fractal dimension, to identify how persistent the volatility clustering is at different time scales. They are attempting to profit from the subtle differences in the fractal patterns. Passive investor's view. For the long-term passive investor, the fractal nature of the market offers a powerful insight. Since the noise is self-similar at all scales, the best strategy is to zoom out to the widest possible scale, decades, and ignore the noise at the smallest scale, daily/weekly, that can only lead to emotional missteps. If the 1-day chart looks like the 1-year chart, the daily noise is meaningless to the long-term goal. The lesson of Chapter 3 is that the market is rough, not smooth. Accepting this roughness, that a spike in turbulence at 10 a.m. is the same phenomenon as a crash in 2008, is the first step toward building a mathematically sound, rather than emotionally comforting, strategy. Chapter 4. The historical case, cotton prices and survival. In this chapter, Mandelbrot steps away from the abstract mathematics to tell the historical story of his discovery, focusing on cotton prices. The data set that first revealed the market's fractal nature, the breakthrough at IBM. Mandelbrot's investigation began with the data on cotton futures prices, a seemingly mundane commodity market. The conventional assumption was that cotton prices follow the Gaussian random walk, like all other assets. However, when Mandelbrot analyzed the price changes, he found profound anomaly, the scaling law. He found that the distribution of price changes remained unchanged even when the time scale changed. When he looked at daily, weekly, and monthly changes, the underlying distribution of the volatility, the proportion of small changes versus large changes, was essentially identical. The pattern scaled. The L-stable distribution. This phenomenon of self-similarity in fat tails can only be described by a class of mathematical models called Levy-stable distributions, or sometimes Pareto-Levy distributions, a family of distributions that includes, but is not limited to, the Gaussian distribution. Mandelbrot's discovery was that the Gaussian model was only one, highly simplified member of this broader family. The financial market data fit a Levy-stable distribution with a much higher exponent, a specific mathematical parameter that describes the fatness of the tails and the severity of the clustering. This statistical reality meant that the risk of extreme price changes was not just slightly higher than the bell curve predicted. It was infinitely greater. The survival of the fattest. Mandelbrot explains that the persistence of this fat-tailed fractal behavior over decades, from a 19th century gold market to the mid-20th century cotton market, proves that it is not a temporary anomaly, but a fundamental, systemic feature of free markets. He suggests that the market's survival mechanism involves these massive price adjustments. Since prices can't follow a smooth path forever, the self-similar bursts of wild randomness are the market's way of suddenly correcting, re-anchoring, or exploding in value. The extremes are not flaws. They're the engine of price discovery. Modern investing application. The cotton study is the origin story for how we should now view all asset classes, from bonds to Bitcoin, the universal fractal. We can now assume that all liquid, exchange-traded assets are fractal. The scaling law means that the risk of a 10% daily crash in stock is statistically related to the risk of a 50% crash over a year. The key risk parameter is the fractal dimension, not the standard deviation. Risk and trading horizons. This chapter fundamentally alters how an investor should view their time horizon. If the pattern of price movement is the same over a day as it is over a month, then a short-term trader is exposed to the same fundamental wild randomness as a long-term holder, just compressed. This justifies a passive investor strategy of ignoring short-term noise. Since the noise is fractal, you're simply trading one fractal against itself, which is a zero-sum game. The only way to win is to exit the fractal noise entirely by focusing on multi-decade compounding. Modeling for extremes. Modern financial technology companies explicitly incorporate the Levy-stable models Mandelbrot discovered. When managing portfolio risk, they don't just ask what the average market movement is. They use a higher exponent of the Levy distribution to quantify the real fat tail risk. This provides a much more robust measure of worst-case scenario. The core lesson is that the market's turbulence is systemic and universal. It is not a flaw, it is a feature. The intelligent investor accepts that the chaos is scale-independent and builds a strategy that is not vulnerable to it at any time frame. Chapter 5. The Two Faces of Randomness. To formalize the distinction between the traditional view of the world and his own, Mandelbrot introduces the twin concepts that define market behavior: the Joseph effect and the Noah effect. The Joseph effect: persistence and memory. The Joseph effect is named after the biblical story of Joseph, who predicted 7 years of plenty followed by 7 years of famine. This effect describes a market's tendency toward persistence and long-term memory, long-term dependence. The market can have periods where prices move in a consistent direction, up or down, for long periods. These long-term dependencies are often interpreted as trends or bubbles. Violation of IID. The Joseph effect is the formal mathematical statement that price changes are not independent. A period of low volatility is followed by more low volatility. A rally is followed by more rallying. This persistence creates the illusion of predictability, which traders try to exploit. The Joseph effect explains the clustering of volatility, Chapter 2, and the ability of the market to sustain long-running trends. The Noah effect, sudden, wild discontinuities. The Noah effect is named after the biblical flood. It describes a market's tendency towards sudden, violent, discontinuous change. Discontinuity. The Noah effect is a mathematical term for the fat tails, Chapter 1. It states that big changes come in sudden, dramatic jumps, which are far more probable than the bell curve allows. Implications. The Noah effect shows that the market is inherently unstable and prone to instantaneous corrections. The crash, the great flood, is always a statistical possibility. The market's misbehavior is a product of the dual action of these two effects. It has persistence, Joseph effect, which creates long, tempting trends, but is constantly interrupted by sudden, violent corrections, Noah effect. Modern investing application. Understanding this duality is crucial for risk management and avoiding behavioral mistakes. The bubble cycle. A speculative bubble, like the dot-com bubble or the Bitcoin bubble, is the Joseph effect creating a long, sustained trend of persistence. Investors are lulled into complacency by the memory of continuous gains. The inevitable crash is a Noah effect, a sudden, violent, discontinuous collapse that erases the gains and reestablishes the base rate, that long-term investing strategy. The passive investor relies on the Joseph effect, the long-term persistence of the economy to grow and compound over decades. Their risk policy, their defensive allocation, is designed to absorb the inevitable, sudden shock of the Noah effect, the market crash. A 40% stock/60% bond allocation is a recognition that the Joseph effect growth is persistent, but the Noah effect crash is unavoidable. The false sense of security. The biggest danger of the Joseph effect is the illusion of control. When the market is calm, low volatility persistence, investors believe risk is gone. Mandelbrot warns that the clustering of calm is just one state of the fractal, and the fat-tailed Noah effect is still a continuous, high probability. The core lesson is that the market is both a memory and an amnesia. It remembers persistence and forgets stability. Your strategy must profit from the long-term memory, Joseph, while being insulated from the inevitable sudden discontinuity, Noah. Chapter 6. A New Language, Scaling and Self-Similarity. Chapter 6 solidifies the mathematical language of the fractal model, making the abstract concept of scaling a concrete tool for analysis. The importance of scaling. Scaling is a mathematical process that describes how properties change when size changes. In the bell curve world, scaling is simple. To find the volatility over 4 days, you simply multiply the daily volatility by the square root of 4, which is 2. This relies on the assumption of mild randomness and independence. Mandelbrot shows that because market randomness is wild and self-similar, the old scaling law is broken. Fractal scaling. In a fractal market, the risk does not grow neatly by the square root of time. The risk is much higher because the fat tails and cluster volatility are preserved at every time scale. Fractal time. Mandelbrot introduces the concept of fractal time. He suggests that the market's activity is better measured not by fixed clock time, seconds, days, but by a deformed, non-uniform time that slows down during periods of calm and speeds up dramatically during periods of turbulence. A day in a crash might be equivalent to a month in a calm period. This time deformation reflects the clustering of volatility. This new fractal language allows for a more accurate, if less convenient, measure of risk, the Hurst exponent. A key tool Mandelbrot advocates for is a Hurst exponent, H, a mathematical measure of long-term memory and persistence in a time series. H equals 0.5, IID/bell curve of Hurst exponent of 0.5 means the price changes are purely independent. With no memory.h greater than 0.5, Joseph effect, an exponent greater than 0.5 indicates positive persistence trends. A rise is likely to be followed by another rise.h less than 0.5, anti-persistence. An exponent less than 0.5 indicates anti-persistence reversal. A rise is likely to be followed by a fall. Mandelbrot's research shows that financial markets consistently exhibit a Hurst exponent greater than 0.5, proving the existence of the Joseph effect, persistence, and the failure of the IID assumption. Modern investing application. The Hurst exponent and fractal time are powerful filters against noise. Filtering out noise. A day trader who sees a stock wiggle randomly is seeing a self-similar fractal. The long-term investor uses the Hurst exponent conceptually. If the market truly has long-term persistence, H greater than 0.5, then the strategy should be to buy and hold, to capture the long, persistent trend of economic growth, and ignore the short-term noise that is not true persistence. Modeling volatility. Financial engineers use the fractal scaling law to model the probability of large losses. They know that the true risk over a month is far greater than the bell curve's simple square root of time rule would suggest. This forces them to set aside much larger capital reserves for the inevitable fat tail event. The FIRE movement in time. The concept of fractal time warns the investor in the FIRE movement that the true risk of retirement is not measured by clock years. A 2-year retirement spent during a severe cluster market crash, high fractal time, is financially equivalent to a decade of calm. The risk is not the time. It is the turbulence within that time. The core lesson is that the market's behavior is quantifiable, but only with the right mathematical tools. If a model fails to account for persistence, Joseph, and sudden discontinuity, Noah, it is dangerously understating the true risk. Chapter 7. The Measurement of Risk. This chapter is a direct application of Mandelbrot's fractal view to the traditional concept of risk, arguing that the reliance on standard deviation is an obsolete, dangerous simplification. The flaws of standard deviation. Standard deviation, or volatility, is a ubiquitous measure of risk in finance. It measures how widely prices are dispersed around the average. Assumption. Standard deviation is only a statistically meaningful measure if the underlying price changes follow the bell curve. The flaw. Since the market follows a fat-tailed fractal distribution, the standard deviation is misleading and often useless. In a fat-tailed environment, the largest price changes dominate the entire history, Chapter 1. A massive outlier event can skew the standard deviation for years. Mandelbrot shows that in a world of wild randomness, the true volatility is often so large that the standard deviation is mathematically infinite. While this is a subtle mathematical point, The practical implication is profound. The risk you think you are measuring with standard deviation is not the actual risk you face. The fractal alternative to volatility. Mandelbrot advocates for replacing the concept of standard deviation with measures that explicitly account for the fat tails. The fractal dimension. As discussed in Chapter 3, the fractal dimension, or its related exponent, provides a robust measure of the market's roughness and its susceptibility to large, discontinuous jumps. It measures the likelihood of the Noah effect, the Hurst exponent. This measures the long-term memory of the market, the Joseph effect. These two measures, the likelihood of extremes and the tendency for persistence, provide a far more complete picture of risk than simple volatility. Modern investing application. The failure of standard risk models explains the systemic failures of 2008 and the continued underestimation of risk by retail investors. The risk-free illusion. Before 2008, mortgage-backed securities and complex derivatives were rated as safe based on low standard deviation, implying a low probability of default. These models ignored the fat tails and the clustering of risk. The Noah effect ensured that when the system started to fail, it failed suddenly and universally, clustering, completely invalidating the mild randomness assumptions. Drawdown as a better risk measure. For the intelligent investor, the practical replacement for standard deviation is maximum drawdown. This is the largest peak-to-trough decline over a specified period. Drawdown explicitly measures the impact of the Noah effect, the big discontinuous drop, and is a more visceral, realistic measure of the financial and psychological pain an investor will endure. If your investment strategy has a 50% maximum historical drawdown, that is a true risk you face, regardless of what the standard deviation predicts. The margin of safety. The realization that risk is grossly underestimated by traditional models necessitates a larger margin of safety in all investment decisions. Since the impossible is statistically common, the investor must be prepared for much greater losses than conventional models suggest. This means holding more cash, demanding cheaper valuations, and using less leverage. The core lesson is that risk is not the absence of volatility. It is a susceptibility to extremes. The intelligent investor's focus must shift from the misleading average to the inescapable tail events. Chapter 8. Time and the Option Market. Chapter 8 focuses on a highly sophisticated, time-dependent world of options pricing, which provides a perfect case study for the failure of the bell curve and the need for fractal time. The Black-Scholes flaw. The gold standard for options pricing is the Black-Scholes-Merton (BSM) formula. It is a mathematical model that revolutionized finance. Assumptions. The BSM model is fundamentally based on a Gaussian assumption. Stock prices follow a smooth, continuous random walk with constant volatility. The reality. Mandelbrot shows that this model is fatally flawed because it ignores the two core tenets of fractal markets: fat tails, Noah effect, and cluster volatility, Joseph effect. Fat tails. The BSM model systematically undervalues out-of-the-money options that are far from the current price, because it predicts that extreme price moves are almost impossible. In the fat-tailed reality, these extreme moves are common, so the options should be much more expensive. Cluster volatility. The BSM model assumes volatility is constant. In reality, volatility clusters. The market knows the BSM model is flawed. Traders don't use the model's actual volatility input. They use an implied volatility that produces the correct market price. When you plot this implied volatility, it creates a volatility smile or smirk, a clear, empirical sign that traders are intuitively acknowledging the fat tails that the model ignores. Fractal time and time decay. Mandelbrot suggests that options should be priced using fractal time. Since the rate of price change is not constant, the effective time left until an option expires is not fixed. Effective time. During a calm period, the clock runs slowly, low turbulence, and the option loses value slowly. During a turbulent period, a crash. The clock runs fast, high turbulence, and the option loses value rapidly. The market is effectively using a deformed time scale. A fractal options model would use the Hurst exponent and the fat tail parameters to generate a more accurate price that fits the real volatility structure of the market. Modern investing application. The options market is the most direct battleground between flawed theory and fractal reality. The cost of betting on extremes. The volatility smirk proves that the market overcharges for protection against extremes and for bets on extremes. This is the practical price of the Noah effect. For the average investor, this means buying out-of-the-money options, pure speculation, is a fundamentally losing game because the price is inflated to account for the actual fat tail probability that the BSM model claims is impossible. The risk of structured products. Many complex, structured products sold to institutional and high-net-worth investors have options embedded in them. If the risk of those options is calculated using the flawed Gaussian model, the risk is dangerously underestimated. The market's inevitable fat tail event exposes a hidden risk, leading to large, sudden losses that fire and portfolio insurance. Even for conservative investor, the flaw in BSM affects portfolio insurance strategies. If you buy an option to protect your portfolio against a 20% crash, the model used to price that option is systematically underestimating the probability of a wider crash. True portfolio insurance against the Noah effect requires acknowledging the true fat tails, which makes the insurance much more expensive than the model suggests. The core lesson is that the market knows more than the model. The fact that options traders intuitively price in the risk of extremes is proof of the market's fractal, fat-tailed reality. The intelligent investor should assume that any price that looks too cheap is based on a dangerously flawed model of risk. Chapter 9. The Fractal Nature of Time. This chapter delves deeply into the idea of fractal time, introduced in Chapter 6, arguing that traditional clock-based time is the wrong metric for analyzing financial markets. Clock time versus trading time. Mandelbrot argues that the conventional assumption that price changes in 1 hour are statistically the same as price changes in any other hour is false. Market activity, or turbulence, is not uniformly distributed. Clustering. Volatility clusters into short, intense periods of high activity, a crash, a bubble peak, and long, mundane periods of low activity, a long, slow summer. Deformed time. Fractal time is a way to mathematically deform clock time, so that equal intervals of fractal time correspond to equal amounts of market activity. When the market is calm, clock time is fast, but fractal time is slow. When the market is crashing, clock time is fast, but fractal time speeds up dramatically. This concept is essential because it is a direct mathematical representation of the Joseph effect. The persistence of turbulence, the multifractal model. While the basic fractal model assumes the roughness is the same across all scales, Mandelbrot proposes a multifractal model. This model allows the roughness to vary slightly at different scales, which better describes the subtle complexities of real market data. The practicality. The multifractal model provides a powerful, advanced way to calculate the Hurst exponent and the fat tail parameters that quantify the market's true risk. The overall conclusion is that market time is endogenous. It is driven by the internal behavior of the market itself, rather than the external tick of a clock. Modern investing application. Fractal time provides a philosophical justification for why many professional traders ignore short-term noise. Ignoring daily noise. For the long-term investor, the concept of fractal time is a powerful behavioral tool. A day of low volume, sideways trading, slow fractal time, is essentially meaningless to a 30-year retirement plan. A day during a major crash, fast fractal time, is highly significant. The intelligent investor learns to differentiate between slow, meaningless clock time and fast, significant fractal time. Your decision to act should be proportional to the speed of fractal time, not clock time. Day trading versus fractal reality. A day trader who makes a living from the random wiggles of a calm market is often generating profits from noise that, in fractal time, represents almost zero actual information flow. The profits they achieve are often canceled out by the sudden, rapid movements during a short burst of fast fractal time. This shows that consistent short-term returns are fighting a scale-independent, self-similar chaos that is almost impossible to reliably exploit. The value of patience. The ultimate strategy in a fractal market is patience. If the turbulence is self-similar across all scales, the only way to escape the zero-sum nature of short-term noise is to wait for the long-term, Joseph effect-driven trend of economic growth to assert itself. The market's long-term trend, though occasionally interrupted by the Noah effect, is the largest, most profitable fractal pattern of all. The lesson of Chapter 9 is that the clock is your enemy. Don't judge the significance of market activity by the hour. Judge it by the intensity of the turbulence. Chapter 10, The Problem of Price. When is it right? This chapter addresses a philosophical question of price in a fractal, unpredictable market, questioning the EMH's assertion that the price is always right. Prices are not just random walks. The EMH assumes that price changes are a random walk, meaning the process that generates them is purely random and cannot be predicted. Mandelbrot agrees that they are random, but argues that they are a wild random walk, one governed by the fat tail clustered in self-similar fractal patterns. The EMH's flaw. EMH claims prices are right because a random walk means all information is instantly incorporated. Mandelbrot shows that because of the Joseph effect, persistence/memory, prices can trend irrationally for long periods, leading to sustained bubbles and depressions. This shows that the market is prone to periods where the price is wildly wrong. Why prices misbehave? Mandelbrot suggests that the market's misbehavior stems from the fact that it is an information filter. Information asymmetry. Information arrives unevenly and is interpreted with herd mentality. This unevenness, combined with the Joseph effect, persistence of mood/sentiment, leads to the clustered turbulence we observe. The herd effect. When a large price change happens, a Noah effect, it sets off the Joseph effect, the memory/persistence of that volatility. The market becomes highly sensitive, leading to further clustered, non-independent price movements. The price is right only briefly. It spends most of its time adjusting to clustered turbulence. Modern investing application. The insight that prices are often wrong for long periods provides the intellectual foundation for value investing. Value investing's thesis. Value investors, like Warren Buffett, inspired by Benjamin Graham, believe that the market price is a chaotic factor that only loosely relates to the business's fundamental value. They explicitly reject the EMH's price is right principle. Mandelbrot's work provides a mathematical justification for this approach. The Joseph effect creates the long, persistent periods of mispricing, bubbles, and depressions that the value investor seeks to exploit. The fat tails ensure that the divergence between price and value is often extreme. Meme stocks and mispricing. The extreme persistence of the price of GameStop far beyond any rational fundamental value is a classic example of the Joseph effect creating a sustained wrong price. The volatility clusters. The sentiment persists, and the price remains wrong for as long as the cluster endures. The value investor avoids a stock, waiting for the inevitable no effect to crash. To correct the mispricing. Passive investing's defense. The passive investor, while not actively exploiting the mispricing, is protected by it. By owning the entire index, they capture both the winners and the losers that are temporarily mispriced. They are protected from the long, persistent trends that favor one sector over another, relying instead on the long-term, non-fractal growth of the economy. The key takeaway is that the market's randomness is a function of the collective psychological memory. This memory creates the persistence of trends and bubbles that allows prices to remain fundamentally wrong for much longer than a simple model would allow. Chapter 11, Hedging, Portfolio Insurance, and the Perils of Time. This chapter focuses on a fractal view of risk management techniques like hedging and portfolio insurance, warning that the misbehavior of markets renders many of them ineffective. The failure of traditional hedging. Hedging involves taking an offsetting position in a related asset to protect against potential losses. Traditional hedging relies on two mild randomness assumptions. Correlation is stable. The relationship between assets, their correlation, is predictable. Volatility is mild. Extreme events in one asset will not wipe out protection in the other. Mandelbrot shows that in the fat-tail fractal world, both assumptions break down precisely when protection is needed most. Correlation failure. During a no-effect event, a market crash, the correlation between almost all assets, even those traditionally considered non-correlated stocks and bonds, tends to shoot up to +1. When the flood hits, everything sinks together. The hedge fails exactly when the market is at its most turbulent. The size of the jump, the size of the fat-tail jump can be so large that the hedge is simply overwhelmed. The protection is based on the mild randomness assumption, but the loss is a consequence of wild randomness. Portfolio insurance and the wrong time. Mandelbrot also critiques portfolio insurance, which uses options or derivatives to establish a floor for a portfolio's value. The time deformation. Portfolio insurance relies on the BSM model and its assumption of clock time. When the market enters a period of high cluster volatility, fast fractal time, the option needs to be adjusted rapidly. The sudden, discontinuous move of the Noah effect is too fast for the hedging mechanisms to adjust, leaving portfolio exposed to the full, sudden drop. Modern investing application. This chapter provides a profound warning against reliance on complex financial engineering during crises. The illusion of diversification. For the long-term investor, Mandelbrot shows that true diversification is a myth during a major crash. When the Noah effect hits, all your equity-based ETFs, international stocks, and commodities will likely move together. The only true hedge against the Noah effect is an asset that is genuinely non-correlated, which usually means cash, which provides liquidity and psychological peace, or long-term government bonds, which historically rally in crises, but this relationship is not guaranteed. The crypto/gold hedge. Many proponents claim that Bitcoin or gold are hedges against the traditional market. Mandelbrot's view suggests that while these assets may not correlate in mild times, their true test is during a major Noah effect. If they are truly non-correlated in the face of wild randomness, they are valuable. However, if they crash just as hard as the stock market when systemic risk emerges, as gold did in 2008 and crypto often does, they offer no true protection. The importance of liquidity. The suddenness of the Noah effect means that an investor must prioritize liquidity. If you are forced to sell liquid assets during crash, you may suffer a loss far greater than the market average. Maintaining an emergency fund in cash is the simplest form of Noah effect insurance. The ultimate lesson is that the fractal market is designed to destroy complex financial structures when they are needed most. Simplicity, low leverage, and holding cash are the most robust forms of risk management against wild randomness. Chapter 12. The Puzzle of Price Bubbles. This chapter uses the fractal model to explain the mathematical structure of price bubbles, showing that they are not irrational anomalies, but a natural consequence of the market's memory and self-similar nature. Bubbles as Joseph effect extremes. Mandelbrot defines a bubble as a long, persistent run-up in price that is fundamentally divorced from intrinsic value. Persistence. Bubbles are the Joseph effect taken to an extreme. The positive memory of the market, the trend, reinforces itself, drawing in more and more capital and leading to an ever faster trend, clustered volatility. The fractal structure allows this persistence to continue far longer than a rational model would predict self-similarity. The run-up of a bubble is itself a fractal. If you look at the price chart of the last year of a bubble, it often looks identical to the price chart of the last month or the last week. The increasing turbulence is self-similar. The inevitable correction, Noah. The existence of the bubble implies the inevitability of the crash. The correction is the Noah effect, a sudden, discontinuous, fat tail event that re-anchors a price. The size of the crash. Because the persistence of the bubble is fractal, the subsequent crash is often equally fractal. The size of the crash is proportional to the size of the bubble. Mandelbrot's mathematical insight shows that the bubble/crash cycle is a systemic feature of financial markets, not a temporary failure of rationality. The market geometry itself permits and encourages these long, mispriced trends. Modern investing application. The fractal view is the best diagnostic tool for identifying a bubble in progress. The meme stock bubble. The run-up in GameStop and AMC was a self-similar fractal. The turbulence in the first day of the parabolic move looked the same as the turbulence in the last day, just amplified. Investors who ignored the fundamentals were trying to exploit the Joseph effect, the persistence of the trend. But the price movement was a pure, fat tail function. The crash was the inevitable Noah effect. The risk of overvaluation. The realization that the Joseph effect allows prices to be irrationally high for a long time should temper the enthusiasm of the fundamental investor. Even if an asset is clearly overvalued, the fractal model warns that the mispricing can persist for years, forcing the value investor to be incredibly patient. The margin of safety must be large enough to withstand prolonged mispricing, selling into euphoria. Mandelbrot's work provides a mathematical justification for behavioral rule. Sell into euphoria. When the market exhibits cluster hypersistence volatility, Joseph effect, the risk of the sudden Noah effect is at its peak, even if the price is still rising. The key lesson is that the geometry of the market permits irrationality. The long, smooth trends we see are not signs of stability. They are signs of a deep, persistent memory that is destined to be violently interrupted. Chapter 13, Time in the Option Market. Part 2, The Real Cost of Risk. This chapter revisits the option market, applying the multi-fractal model to derive the real, non-Gaussian cost of risk, the multi-fractal price. Mandelbrot explains that the multi-fractal model provides a far more accurate price for options than the BSM model, a different law of scaling. Instead of using the square root of time rule, the fractal model uses a different power law based on the Hurst exponent and the fat tail exponent. This new law shows that volatility grows much faster with time than the Gaussian model assumes. The true value of the tails. The multifractal model accurately prices the out-of-the-money options because it quantifies the probability of the extreme fat tail move, the Noah effect. The model's price is significantly higher for these tail events than the BSM model's price. This confirms the empirical reality. Traders intuitively acknowledge that extreme moves are common, and the fractal model provides the mathematics to back up their intuition, the risk premium. Mandelbrot argues that the difference between the BSM model's price and the fractal model's price is the true, hidden cost of market misbehavior, cost of simplicity. The financial system is built on a convenient but wrong assumption of mild randomness. The true cost of risk, as shown by the multifractal model, is higher. This insight is a fundamental critique of the notion that market prices perfectly reflect risk. Modern investing application. This chapter provides a final mathematical warning to all speculators. The unprofitable speculator. Any speculative trading that relies on the expectation that volatility will remain low or that extreme events will not occur is mathematically flawed. The average retail investor who buys short-term options, trying to capture a quick price move, is competing against models that explicitly price in the high probability of a sudden, discontinuous event, Noah. They are essentially selling a guarantee of stability in a market that is fundamentally wild. The systemic cost of flaw. Mandelbrot's work implies that the entire financial system carries a hidden fractal tax. This tax is the difference between the risk calculated by the flawed Gaussian model and the risk calculated by the accurate fractal model. This tax is paid out during the large, systemic crashes, which are the sudden realization of the previously hidden risk. The core lesson is that you cannot model a fractal market with Euclidean tools. The true cost of risk, even when not explicitly calculated, is always higher than the comforting, smooth model suggests. Chapter 14, Time, Risk, and Value at Risk. Chapter 14 applies a fractal critique directly to value at risk VAR, the banking industry's dominant tool for regulatory compliance and risk management. The danger of VAR. VAR is designed to estimate the worst expected loss over a specific time horizon at a given confidence level, e.g., the most you stand to lose 99% of the time over the next day. The Gaussian flaw. VAR relies heavily on the bell curve. It quantifies the risk only up to a certain confidence level, e.g., the 99th percentile. The missing tail. Since the market has fat tails, the losses beyond the 99th percentile are far larger and more frequent than the bell curve predicts. VAR provides a false sense of security by ignoring the high probability of the Noah effect. As Nassim Taleb said, VAR models are like giving a bomb disposal expert measure the sound level of the blast. They measure the average chaos, but ignore the catastrophic potential. The fractal solution for VAR. Mandelbrot argues that a meaningful VAR model must incorporate the multifractal parameters. The power law. A VAR calculation based on a Levy-stable power law, which accounts for fat tails, will produce a loss estimate that is many times larger than the bell curve's estimate. This is the only way to accurately quantify the risk of the extremes. Modern investing application. The lesson of VAR's failure is crucial for the individual investor managing their personal risk. Risk over time. Mandelbrot's fractal model warns that for the individual investor, the perceived risk often decreases too slowly over time. The risk of a major crash remains high, even over multi-year periods. The safe portfolio drawdown. When planning for retirement, e.g., using the 4% rule withdrawal, the intelligent investor must assume a worst-case drawdown far exceeding the historical average. If historical data shows a 50% max drawdown, the fractal model warns that a 60 to 70% drawdown is statistically probable. Your withdrawal plan must be robust enough to survive the higher probability of the Noah effect. Cash is the ultimate safety. The only asset that truly counters the systemic failure of VAR and the fat tails is cash. It provides the liquidity and the psychological buffer to withstand the inevitable crash, NOAH, and exploit the resulting mispricing. The core lesson is that the most important risk is the risk that traditional models tell you is impossible. The intelligent investor operates with a constant, humble assumption that their calculated worst-case scenario is actually the mid-case scenario. Chapter 15, What Can Be Predicted? This final analytical chapter addresses the central question of finance. Can the market be predicted? Mandelbrot provides a nuanced, fractal-based answer. The unpredictability of price, NOAH. Mandelbrot asserts that the vast majority of short-term price movements are inherently unpredictable. Wild randomness. Because the NOAH effect discontinuous jump is a permanent fat tail feature, the timing and size of the next extreme move cannot be reliably predicted. Any short-term prediction is a zero-sum game. The predictability of turbulence, Joseph. However, the fractal model reveals a crucial area of limited predictability, turbulence. The Joseph effect. Because volatility clusters, the Joseph effect, the likelihood of turbulence persisting or returning can be predicted. If the market is currently calm, it is likely to remain calm. If it is turbulent, it is likely to remain turbulent. You can predict volatility, but not the direction of the price. This predictability of the state of the market, calm versus wild, allows for a rules-based, adaptive strategy. Modern investing application. The distinction between predicting price and predicting turbulence is the key to all modern, successful quantitative and passive strategies. Trend following. The only predictive edge a momentum or trend following strategy has is the Joseph effect, the persistence of a trend once it is established. These strategies are exploiting the market's memory. Passive investor prediction. The passive investor relies on the most robust prediction of all, the long-term Joseph effect of the overall economy. They predict that the long-term trend of economic growth will persist, and they ignore the short-term, unpredictable NOAH effect. Their prediction is about the long-term state growth, not the short-term price. Adaptive risk. Mandelbrot's model suggests a more adaptive approach to risk management. When a volatility indicator, like the VIX, is low, indicating a calm state Joseph effect, it is a good time to buy. When the VIX is high, indicating a turbulent state, it is a time for caution, less leverage, and more cash. You cannot predict the drop, but you can predict the risk is clustered. The ultimate lesson is that humility is a statistical necessity. The intelligent investor limits their predictions to the predictable persistence of long-term trends and the clustering of risk, and humbly accepts that the short-term direction of price is unknowable. Modern context expansion. If Benoît Mandelbrot, the father of fractals, were to observe the financial markets today, he would not be surprised. He would be vindicated. The rise of meme stocks, crypto volatility, and algorithmic trading are not exceptions to the rule. They are the ultimate expression of his wild randomness and fractal time, vindicated by the extremes. Crypto as pure wild randomness. Mandelbrot would see Bitcoin as the most perfect, unadulterated example of a fat-tailed, levy-stable distribution. Its extreme, discontinuous daily jumps would confirm that the NOAH effect is a continuous, high-probability feature. He would argue that attempts to model Bitcoin with a bell curve are laughably inadequate. Meme stocks and the Joseph effect, a long, persistent, irrational trend of assets like GameStop, is a textbook example of the Joseph effect persistence, amplified by social media. Social clustering reinforces the volatility clustering, leading to sustained mispricing. The fact that prices can remain so far from fundamental value for so long is the power of the market's memory. High-frequency trading, HFT and algorithmic trading are forced to deal with fractal time and self-similarity. They know the turbulence at the microsecond level is the same as the daily level. Their entire profit model is based on predicting the short-term clustering of volatility, Joseph effect. The high speed of the market is just a compression of Mandelbrot's fractal time into its smallest possible measure. The humility of the tails, the realization that extreme events are common forces an investor to stop predicting and start preparing. The goal shifts from maximizing returns to maximizing resilience against the NOAH effect, fractal time, and discipline. The knowledge that short-term noise is self-similar across all time scales justifies the passive investor's patience. The short-term turbulence is irrelevant to the long-term, Joseph-driven trend. Discipline is the only way to avoid being consumed by the self-similar chaos. Margin of safety is fractal insurance. Demanding a large margin of safety and valuation is a financial equivalent of the fractal power law. It is the explicit acceptance that the price you pay must be cheap enough to withstand the probability of a sudden, discontinuous drop, Noah, and the possibility of a prolonged period of mispricing, Joseph. Mandelbrot will conclude that the market is a terrifying, beautiful, and wildly complex system. The only way to survive is to abandon the comforting simplicity of the past and accept the mathematical reality of the infinite chaos. Closing reflection. We have explored the revolutionary work of Benoît Mandelbrot and discovered that the financial world is not smooth and manageable. It is rough, jagged, and ruled by wild randomness. The biggest lesson is that you must base your financial strategy on the world as it is, not as you wish it were. Here are 10 timeless lessons from the misbehavior of markets for the intelligent investor. Ditch the bell curve. Assume the market has fat tails, meaning extreme discontinuous events, the Noah effect, are common and will dominate your long-term risk profile. Focus on drawdown, not volatility. Replace the misleading measure of standard deviation with maximum drawdown. Plan your finances to survive the largest historical percentage loss, plus a buffer. Risk is clustered. Acknowledge the Joseph effect. Volatility and trends persist. This means periods of calm are deceptive and risk is not a constant. Simplicity is the best hedge. Complex financial engineering fails when the Noah effect, the crash, hits because correlations go to 1. Low leverage, simplicity, and cash are the most robust forms of protection. Cash is true insurance. Since correlation fails, the only true hedge against a systemic crash is holding cash. It provides liquidity to survive the storm and exploit the mispricing that follows. Zoom out. The noise on the 1-minute chart is self-similar to the noise on the 1-year chart. Ignore short-term noise because it is a zero-sum, scale-independent game. Embrace the long-term Joseph effect. Rely on the most stable prediction, the long-term persistence of economic growth. This is a mathematical justification for the passive buy-and-hold strategy. The price is often wrong. The Joseph effect allows prices to be irrationally high bubbles or low depressions for persistent long periods. This creates a window of opportunity for the disciplined value investor. Margin of safety is fractal necessity. Demand a large margin of safety in all valuations. It is a required buffer to withstand the inevitable sudden, discontinuous drop, Noah, and the prolonged mispricing, Joseph. Time is not uniform. Base your decision act on turbulence, fractal time, not the clock. When turbulence is high, reduce risk. When it is low, buy. How to apply these lessons right now. Audit your drawdown risk. Go beyond simple volatility metrics. Understand the maximum historical drawdown of your chosen asset allocation and ensure your cash reserves are robust enough to allow you to survive that drop without selling. Establish a crisis cash buffer. Designate a specific, liquid cash reserve for a no-effect event, a 30% plus market crash. This reserve serves as both portfolio insurance and dry powder to buy mispriced assets during the turbulence. Invest mechanically by automating your monthly contributions. You are betting on the Joseph effect of the long-term trend, which is the most powerful and persistent fractal pattern of all. You are ignoring the short-term chaos, which is the most dangerous aspect of the market. Mandelbrot's path is a commitment to seeing the world as it truly is, a wild, beautiful, and dangerous fractal. By accepting this inherent chaos, you move from being a victim of the market's misbehavior to an intelligent agent prepared for the inevitable extremes. And there you have it, the profound, challenging wisdom of Benoît Mandelbrot's The Misbehaviour of Markets. It's not just a book about mathematics. It's a manual for risk and survival in a world that is far more unpredictable than we dare to believe. We hope this deep dive summary has given you the courage to look beyond the bell curve and adopt the robust, simple defenses required for a fractal world. If you found value in this breakdown of the misbehavior of markets, make sure to subscribe to Capitura and click that notification bell. We're on a mission to bring you the world's most powerful financial wisdom, chapter by chapter. And you won't want to miss what's next, because we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and be prepared for flood.